Good afternoon and welcome to the College of Continuing and Professional Studies webinar, Finance Fundamentals for Better Decision Making. Thank you so much for joining us today. Next slide, please. My name is Shanta Bulai, and I'll be your moderator for today's webinar. If you have future questions about this webinar or other programs we offer, the college's contact information will be on the last slide of this presentation. So I am delighted to introduce the topic for today's webinar, Finance Fundamentals for Better Decision Making. In today's data-driven workplace, building strong financial and business acumen is essential for effective decision-making, strategic planning, and long-term success. In this webinar, we'll offer a practical and engaging introduction to core financial concepts. Participants will explore foundational principles, begin interpreting financial statements, and learn how to approach budgeting and forecasting with confidence. Whether you're new to financial responsibilities or looking to sharpen your skills, this session will help you better understand the numbers that drive your organization. And today, the actionable strategies will include strengthening your understanding of key financial terms and business drivers, read income statements and balance sheets with greater confidence, develop budgets and support strategic goals and operational priorities, and lastly, forecast future trends to enable more informed planning and resource allocation. It's a pleasure to introduce the presenter for today's webinar, Terrlyn Wallace. Terry, the founder of Terrlyn Wallace Consulting, brings decades of experience in financial strategy, business leadership, and team development, with a passion for making finance approachable and empowering professionals to lead with confidence. Terry blends technical knowledge with real-world insight to help individuals and teams thrive. Terry, thank you again for being with us and sharing your wisdom. I will pass it over to you.
Wonderful. Thank you, Shanta, and thank you to the College of Continuing and Professional Studies for hosting this webinar and for the new series that we are excited to share some information about today. So whether you're here to gain some understanding of these financial topics, fundamental areas in the next hour, or if you are here to learn more about the upcoming course, we're really glad that you are here today. So just a slide here on the front end of things to talk about the new program that we'll be launching later this summer, early fall timeframe regarding fundamentals of finance. The objective of the course overall is to empower professionals to understand and apply core financial principles. So today, as we move through our time together, I will be sharing what some of those core financial principles are and just touching on those and giving a very brief overview. And we invite you to join the four-week online course. Each week, we will have a 90-minute Zoom session in the early evening hours where we can get together and talk about things, and I'll be leading you through a number of areas as well as the content, making sure that the content that we've provided through that classroom is meeting your needs in order to grasp those foundational principles that the course has put together. Our target audience are managers, team leads, and aspiring business leaders without formal finance training. So this course is really intended for individuals that want to build their business acumen, who may be moving into positions of responsibility that perhaps need to understand more financial information, perhaps do planning and prepare suggestions or projects using some of these concepts. And so we hope that not only this fundamentals course, but two additional courses, one on budgeting and another on forecasting, can come together and really provide that overall need that many would be having in those types of roles. So kicking off today, we want to touch on a number of foundational areas of finance with our time together today, and really building our financial literacy and knowing that having financial literacy can really help us in positions that we have, whether that is in an organization that we are employed at, it is projects that we are doing on our own, launching our own businesses, or participating in community needs. Having some financial literacy is very helpful. It enhances our strategic decision making. It takes those strategic decisions and applies the execution that we want to complete with the monetary needs of that and what the impacts financially will be. Having financial literacy allows us to more fully participate in the budgeting and forecasting processes. And when we participate in those processes, budgeting and forecasting are both estimates. They're never the actual results, but we're always striving to have methodologies and models and systems and processes that will get us closer and closer to doing that planning in the most accurate form that we can. Having financial literacy also facilitates effective communication with financial stakeholders. So again, whether you find yourself in a role in an organization that you are employed at, doing something in your personal life, or serving your community, understanding what the needs are of that organization and how the finances of that are coming together and being able to effectively communicate really is an important part of bringing those organizations together. And as you can just see from the infographic, the interaction between having financial knowledge and having financial literacy goes hand in hand with building your financial capability, which really through this 4-week course, we will be spending our time intentionally building those capabilities, which then brings financial inclusion, the ability and opportunities to act in areas, whether it's products, services, institutions, strategic execution, and that knowledge can be applied in a number of different forms and fashions. So taking some of these foundational concepts with the time that we have together today, a brief 1 hour in the Central Time Zone over the lunch hour, I want to touch on some foundational areas that really help us build that financial literacy. The first being having some understanding about financial statements. Now, our financial statements that we typically refer to in most businesses are the income statement, the balance sheet, and the cash flow statement. 2 of these financial statements are where the actual accounting work is completed. In other words, the debits and the credits are occurring on the income statement and the balance sheet. And the cash flow statement is a little bit different in that there are no accounting entries that actually occur on that statement, but it is the compilation of information from the income statement and the balance sheet that come together and show us where the dollars have been spent, whether they were on the income or the operating side of the business, or whether they were on the balance sheet side of things. And we'll talk about those in the next couple of slides just to delineate what the difference is in that income statement or operating statement compared to the balance sheet. So just taking a brief look here at a typical income statement or a pretty compressed one, just the very top section of the screen here. If you think about an income statement, it's really trying to communicate information about the amount of revenue that came in, whether that comes from sales or whatever that revenue source is. That revenue then is totaled and it is reduced by a number of expenses. Depending on what the application is, those expenses may include a cost of goods sold. So if we're building something or creating something, it takes products and goods in order to actually create or make the product or good that you are selling. That's going to be a top expense. Those cost of goods sold are typically when a top expense communicated on the income statement. And then we have a variety of other expenses. Some of those expenses may be fixed expenses, things that no matter how many of an item you produce or the quantities that you sell, you're still going to have a fixed cost to go along with them. Things like insurance premiums would be an example, where other expenses that you have may be variable and they may be correlated or contingent upon the amount of sales or the quantity of sales that you have. We also have additional needs that are happening on the income statement in the areas of marketing, communication, providing customer service, administration of our businesses, financial accounting, IT type services, legal, things like that are all included in the expense area. Once we've paid all of those expenses, we take the difference between the revenue that came in and the expenses that were incurred against that revenue, and what we have left over is our net income. So understanding if a project or an overall business or the organization that we're working for is profitable from a revenue less expense side of things is important, both large scale and then as you drive into that in particular departments and particular projects that you may be working with in your career. Moving on to the balance sheet. The balance sheet could be summarized as the financial statement that shows what the organization owns. Those would be considered our assets. Typically, if you've heard of a balance sheet before, it has two sides and it balances. And that one side has the listing of everything that is owned. And the other side of the balance sheet, the second side, contains how we pay for those things. Whether we pay for those things through margins that have come in the past. So over the years, your income statement has produced net income. That net income has become a part of the business or retained earnings. Another way would be if your company sells stock or has some sort of ownership that can come in to help pay for those things. That would be a second area. And a third area, generally speaking, would be borrowing, whether those are bonds or loans, short-term lending, long-term lending. And together, those overall methodologies of retained earnings, stockholders' equity, long-term debt, those are going to be the ways that we then finance the assets that the organization has. And last but not least is our statement of cash flow. And our statement of cash flow is where we take information from these prior to financial statements and we put them into some different categories, as you can see listed in the details of the cash flow slide. We have operating activities, investing activities, and financing activities. And so looking at our operating activities, that's really going to correlate typically back to the activities that happened back in our income statement. If we have done accrual accounting, we're going to convert that accrual accounting and remove from that accrual accounting the expenses that have not actually been incurred that took cash. So it gets us back to a cash basis. And then in the second category of investing, if we think about investments that a business might make, typically that may be on the balance sheet side of things. We're putting money into a business, we're putting money into something that is going to take cash flow. And then to overall summarize our financing activities, if we're going to utilize the right-hand side of our balance sheet in order to pay for those investing activities, what's the income or incoming cash flow that we need from those different sources that I mentioned on the right side of the balance sheet. And if there are payments against those, say you take on a long-term loan or a multi-period loan and you have payments back against the principal, you would have cash inflow for the new cash that you need, and then you would have some cash outflow for the payments for the prior obligations of mortgages and notes that you would have. And so ultimately what the cash flow statement is telling us is what do we have in our cash accounts and where did all that money go? That money must have gone generally into one of these three categories: operating activities, investing activities, and financing activities. So there's kind of one of the first fundamental areas that we will dig into much more thoroughly in the 4-week course. But I also wanted to add today the opportunity for you all to interact with this webinar. And so we have 3 polling questions spread throughout our time today. Hope that you will participate in those. It's a good way to make sure that we stay engaged with the learning with our time together. One thing I know about adult learners, as I have studied adult education and really with intention want to reach as many of the adult learners that I can in my time with you, time is often brief. So while you have approximately 22 things on your mind, if you're a typical adult learner, using polling questions is a great way to just kind of reinforce some of the conversations that we have along the way. So we'll do that briefly 3 times today. And with the support of the team here, we're going to go ahead and launch our first polling question. So you'll see that polling question, and if you have participated in an online setting like this before, you can go ahead and just use your mouse and select the answer that you think best applies, and we'll show the results in just a minute. So the question is, what financial statement shows a company's profitability over a specific period? So we have talked in the last few minutes about the balance sheet, the cash flow statement, and the income statement. We didn't break specifically into the equity report, which is derived from a portion of the balance sheet. But the question here still remains, which financial statement shows a company's profitability over a specific period of time? Give you all just a moment to answer, and then we'll move forward with our conversation. All right, we're probably ready to close that polling question, and let's take a look at the results. Which financial statement shows a company's profitability over a specific period? And the answer is the income statement. So the income statement tells us the difference between the revenue that came in, the expenses that went against that revenue, and what was remaining afterwards, whether that is called margin or profitability. It's the difference between that revenue and those expenses. And of course, typically it is viewed as positive. We want that number to be a positive number. We want to have more revenue than we have expenses so that we have sufficient cash to be able to cover those expenses. So with that, we'll close and just make a couple of comments, back cleanup on these three financial statements and move on to our next topic area. So again, the income statement, will take a little bit deeper dive, of course, into the course, but understanding the components that feed into revenue, where revenue comes from, how to calculate revenue. If you're doing a project or you want to make a proposal, what are some things that you want to think about from the income side of things? Next, we have the expenses. Those expenses, again, could be related specifically to cost to build or to be a cost of goods sold, directly relating to the revenue that you're going to bring in from the sales, or they may be additional variable or fixed costs that the business may need to incur just generally, or they could be directly related to the volume of sales that you have in the revenue area. The difference between those two is our net income. And an income statement, as that question went on to say, is specifically for a period of time referred to as a fiscal year. So 1 year period of time is the range of an income statement. Very common to have a January through December that follows the calendar year, but a calendar year is just one example of a fiscal year. Your fiscal year of an organization may start in any month and it would end then 12 months later. On our balance sheet, as we talked about, we have three main areas: the asset area, or the items that we own, and then the other two areas, liabilities and equity, are the two ways that we pay for that. And the difference between liabilities and equity is liabilities is that we owe for those things. We've taken on an obligation, whether those are bonds or mortgage, long-term, short-term borrowing. And the equity section is generally coming either from margins that have come from in prior periods that the business has been in existence, or the equity is coming from shareholders who are holding on to stock. So balancing that balance sheet is critically important. Making sure that the evaluation of your financial position is meeting metrics and expectations of shareholders, decision makers, boards, is all critical to having some of that financial literacy in the roles that we have. And last but not least was taking that information and breaking it down into these three categories: our operating activities, our investing activities, and our financing activities. Again, same information that would be presented really on that income statement and that balance sheet, but presenting it in a way that shows whether the cash went in or the cash went out in those three categories, kind of just summarizing where our cash flow came from or where our cash flow went through due to our business activities. So as a result of talking about these three financial statements, I want to, next transition into the difference between profit versus cash flow. And so as I think about ourselves as individual people, most of us operate on what I would call on a cash basis. When we receive income, we recognize that we receive that income when we get the cash. So especially if you're employed by an employer and you think about payday, payday is when you receive the cash in, and then when you expend that cash, that is going to be cash out. And so we don't do what is called accrual accounting. Typically, as an individual, accrual accounting does come into play for businesses that are stating their financial information based on transactions that have occurred, but maybe the cash has not necessarily followed in that same time frame. So there is a difference between profitability and what your actual cash flow is. Both of them are very important measurements of the health of any business, but they are two different things. So profit is communicated and determined on that income statement. However, some things on the income statement may not have a cash flow. For example, if you buy a large piece of equipment or if you purchase a building, the cash for that may go out the door, and that will be an asset that we own over on the balance sheet. However, on the income statement, the purchase of that will not be 100% reflected as a direct expense. So typically in the business setting, the useful life of that item that was purchased, that's going to be depreciated. Depreciation becomes an expense. It's the incremental amount that each one of those purchases is whittling its way down from the purchase value to a zero value or a zero value plus what you would sell it for as a salvage. And so that becomes the amount of expense that you're going to see. So we need to adjust that income statement for expenses that are non-cash in order to get to our cash position. So that's really kind of one of the purposes of the cash flow statement in this slide before, is it helps us remove some of those accrual entries to really then correlate back specifically to the cash that came in and the cash that went out for our business, and to reconcile that into those three categories. That's our actual cash flow. That's not our accrual accounting, which likely impacts our financial statements, both our balance sheet and income statement. And so we eliminate those pieces and parts when we put together that cash flow statement. So there's just a tidbit about the financial statements. Once we have financial statements, now the world opens up to a number of things that we can do with that financial information that really helps us make great decisions. And that's where you can tell I get excited. Not that financial statements aren't exciting, they're fundamental, they're core, but when we have that financial information, one of the things that we can do with that information is generate some ratios. So ratios, just like the word ratio says, it's the comparison between two things. So on the right-hand side, I have a graphic that is just trying to show us that there's going to be a numerator when it comes to ratios, and there's going to be a denominator. It's the relationship between two things, especially for non-financially viewed individuals. Ratios are a better way to communicate information. Let me give you an example. If I just said that there was 1,000 of something, and I just used a number, $1,000, it's hard to know if $1,000 was a really big number, $1,000 was a really low number. Like, what does the 1,000 mean? But if we convert that information to a ratio, now it can have much more perspective. For example, if the result of that ratio is 98%, well, 98% likely we're making some assessments early on that it's like, okay, 98%, it's usually 98, the top would be 100, so it's really high. So now the question remains in our analysis, is being really high, is 98% a really good thing, or is 98% a really bad thing? Well, we're going to need more information. We're going to need comparative information, but ratios help us at least start by establishing what our financial results are. And a few key areas that I have listed here are liquidity ratios, profitability ratios, and leverage ratios. And these are just 3 examples. There's many, many more that help us assess financial health, but liquidity ratios help us understand if the liabilities or the payments that we need to make, especially to vendors and current bills that we need to pay, do we have sufficient cash to pay those? Like being able to pay our employees and being able to pay those vendors that have provided us supplies and services is really important to the financial health of a business. Likewise, profitability ratios are going to focus on what is left over after the revenue has paid the expenses, or revenue minus expenses, and then we can establish whether or not the profitability is meeting our expectations when we have comparative information. So first, calculating our information based on our financial results is going to be our starting point. And leverage ratios are going to do similar things. They're just going to take into consideration what our debt position is, or our obligation position. And so you can determine if you're highly leveraged, highly in debt, or not highly in debt. And is that then compared to perhaps your budget or other metrics that have been set for the organization? So ratios, just a quick way to summarize this, is a way for us to determine the financial health based on that information. And then when you align that multiple periods, perhaps month after month after month, or quarter after quarter after quarter, year after year after year, you're creating some trends. Trends allow you to see, are we trending up? Are we trending down? Are we trending flat? And then we just need to know if the plan was that we are, and are we headed in the right direction? We need that comparison still to know if the ratio is good or bad. But the financial ratios oftentimes are preferred way to be able to quickly assess and determine thumbs up or thumbs down to our financial position. The next concept is the time value of money. And the overall concept here is that a dollar today is worth more than a dollar tomorrow. And we have a variety of applications that we can use the time value of money concepts with. Present value means that we want to determine things that are going to happen in the future, and we're going to bring those back to today's dollars. And then the future value would be kind of the opposite of that. If we have either something that happens today or something that happens over a variety of periods, ultimately, what will the future value of that be? And it takes into consideration quantity of time. It's also going to take into consideration an interest rate. Oftentimes, those interest rates or those rates are going to be an assumption, and we don't always have the exact answer to that, but it gives us an ability to take a look at what we think is going to happen and apply those rates to that, and then determine what either the future value of something would be or the present value, depending on what the scenario is. So this allows us to take a look at discounting and compounding over time. So we would discount it back to today's value, or we would compound it forward. For example, if you make an investment, you're expecting that you're going to earn a return on that you're going to compound, and your future value is going to be greater. Really, really important concepts when you're making decisions, whether it's for an individual budget or for an overall organization, making a strategic decision about a direction that they're going to go. It's beyond just what today's dollars are, but understanding these time value of money concepts, really important as well. Now, most of the time, taking those same concepts and just kind of adding one more layer of complexity to it, they don't typically happen neat and inside of a square box, one period, and things just happen and it's done and we can assess it. Oftentimes they're happening over multiple periods or incrementally over time. And so the net present value is a method that we can use to calculate what those future cash flows are in today's terms, meaning it isn't just one period that we're going to then apply a rate to, but we may have a period at, say, 1 year, a period at 2 years, a period at 3 years, and we have different cash inflows or cash outflows that we need to discount or compound into that present value or future value calculation. So if we bring that into the present value for future cash flows, the net present value allows us to do that for multiple periods and take several periods into consideration in our calculation. Now we can also utilize a calculation for that called the internal rate of return. And the result of the net present value in the internal rate of return will give you the same business decision. But think of it this way. For some of you, this may, maybe applies. But I think about back when I was doing some of my math when I was in grades K through 12, and sometimes we would have to look to the appendix of the book in order to get factors. We would multiply that by our math equation and we would get a result. The internal rate of return is going to use typically a financial calculator, and it is going to apply those factors and give you the result of what that internal rate of return is. And again, if your internal rate of return result is positive and you use that same information for a net present value, they're both going to give you the same overall result. One of them, there's just two different approaches to the process of evaluating opportunities or projects that you may be taking a look at. So more to come on that. Join us for the 4-week course. So I mentioned return on investment in the last slide there. Certainly if we are ourselves or a business is putting an investment into a project, into a business, the expectation is that they're putting that money into the investment because they're assuming that there's going to be some sort of return. Now the return is basically determined based on the amount of investment that you put in versus what the cost of that investment is. You can divide that by the cost of that investment, and that's going to tell you what your percentage return was. Most simple form that you can think of is if you make an investment into a bond or into just a CD or something like that, and it's a specific rate of return for a specific number of months. Let's say that it is a 5% rate of return. You know what your rate of return is going to be. You can prove that out then by the dollars that you put in on the date of the investment. And then at the end of that investment period, you should have 5% more dollars that are returned back to you. And you would then see that you earned that 5% rate of return. So rate of return helps us measure the efficiency of our investments. It helps those that are looking at making investments determine if that rate of return fits what their risk profile is. Is it not risky enough? Is it too risky? And then it allows them to compare if their actual rate of return was satisfactory compared to what their estimated rate of return was based on initial information they had about the project. Sometimes rate of returns are given and they are fact. Sometimes rate of returns really come about because we plan for projects and then we execute that and we find out what the actual is along the way. So that leads us towards risk and opportunities. So when we make decisions or we're looking to make decisions on things we've never done before, there's risks that perhaps things may not turn out the way that we thought that they would. And oftentimes, if you have an opportunity or you have an investment or something that you're assessing, it's often typical to see that you're going to receive a greater return and potentially even a return on your investment, like we just mentioned in the previous slide, based on the amount of risk that you take. So the greater the risk, the greater the reward, the greater the risk, the greater potentially the loss of that reward as well. However, if you take on less risk, likely the return of that is going to be less as well. So there's a number of things to take into consideration when it comes to risk. But if we don't take opportunities, there's a cost to that as well. So we need to also have an approach of understanding the cost of foregoing an alternative that comes our direction. So if we don't make an investment into something, there's no possibility that we're going to have a return on investment, kind of utilizing that prior slide there. So those are some of the fundamental areas that this 4-week course is going to embark on. We're going to use some interactive scenarios. You're going to be utilizing information that's practical and realistic for you as an attendee into the course. So that hopefully will, allow you to not only experience and practice with the fundamental concepts, but really be able to apply it in your real life as well. And many of these fundamentals, as I mentioned earlier, still need to have something to compare to if we actually go forward in doing them. So before we actually go forward in doing projects or an entire year of business, it's pretty typical that we're going to do some planning. Two approaches to planning, or two different ways that we want to look at doing planning. One would be short-term planning. I typically think of that as a budget. Typically, it's a 1-year period of time, or it's a fiscal year where we set financial goals and we really dig into the details of estimating revenues and expenses in fine detail for that particular year. And then as those results come in, we can monitor what those results are. And if we feel appropriate, we can even adjust those results. There are a number of methodologies we can use using typical spreadsheets that will be part of one of the 3 parts, one of the 3 courses on budgeting. You will become experienced using spreadsheets. You can also utilize budgeting software. We're not going to be using that in the classroom setting because it's really going to be that opportunity to touch and manipulate the financial information, and spreadsheets are a great way to do that. So if budgeting and being a part of that planning process would be new for you, this is a great opportunity to practice those skills and learn a number of the key concepts that go along with budgeting. Now, if we take that concept a little bit bigger, from a time horizon perspective, now we're talking about forecasting. And we will also be doing forecasting in the 3rd part of there's 3 courses to this certification, and forecasting will allow us to analyze historical information, do more trend analysis, and look at various models, regression models, and techniques that go along with forecasting in order to predict the future, and in order to really look at the relationship between different variables that we're planning for in those models. So all ties together, but we'll be expanding beyond the 4 weeks. There's a lot of information here to gather all of those different concepts. So that was just kind of a sneak peek for the budgeting course module, again, 4 weeks, and a sneak peek for the forecasting module or course as well, that will also have 4 modules. So inside of this planning, another aspect of planning, and we will practice this in those 2 later courses, are making decisions about capital projects or capital expenditures, investments that we want to make. And typically, if we're going to expend money for something, we're looking for there to be a return. Or we're going to take a look at what the net present value is. We're going to compare the cash inflows and the cash outflows and see if it meets the requirements of our organization for profitability. It allows us to figure out and to plan for projects to see where they're going to go and make an informed decision if it's a good choice or not a good choice based on the other information to go ahead and make those capital budget purchases. So we make a purchase, we want it to be from an informed perspective. We want to make sure that we're meeting the expectations of the organization. We don't want surprises that say, well, I thought, you can see the example here is an ice cream business. I thought if we bought a truck, we would be profitable. It takes a lot more planning than that. How are we going to bring in the revenue? make sure that we cover the expenses. And at the end of doing all of those efforts, what will our margins be? Will we be able to pay for the expenditure that we've made in the time frame and at the rate of return that meets the expectations of all decision makers? All right, I did miss, I had a second, well, it fits in here anywhere, but I'm going to just slide back for just a minute here to net present value. And we're going to launch our second polling question. So mentioned that I had 3 of them today. So here's our second polling question. It has to do with these concepts that we've been talking about with net present value. So our second question is, what's the main purpose of net present value? Is it to compare income to liabilities? Is it to estimate future stock prices? Is it to calculate the value of future cash flows in today's terms? Or is it to determine past investment performance? 4 choices for you there. Go ahead and make your selection. Give you just a moment. Now that everybody's practiced this once, we'll probably do it a little more quickly than we did the last time, but I'll give you a moment to reread if you'd like. All right, we'll go ahead and close that poll and share it. And the answer we were looking for today is to calculate the value of future cash flows in today's terms. All right. So going to move back ahead in the slide deck here and talk about one of our final concepts that we have for today. And then I'll start kind of closing things around. We do have some time here at the end for Q&A. But the last concept that I want to talk about is break-even analysis. So the overall concept here is that with any given sales volume, we want to compare that sales volume to the total costs that it takes to serve or to make something. And we want to determine at what point do we break even. So at the front of the webinar today, I talked about both variable costs and fixed costs. Sometimes it takes fixed costs that need to be paid no matter what the sales volume is. So the more that you would be able to sell, the more that you would be able to produce and then sell, those fixed costs on a per unit basis are going to decrease. And so when you take into consideration what your plan is through the forecast and maybe through the 1-year budget about how much is going to be produced in a specific year, you can then take those fixed costs. You can also take the specifics about the sales for the variable costs and determine what your total costs are going to be. There needs to be some assumptions that go along with that. And that's what those processes, budgeting and forecasting, help us do to predict and to plan to the best of our ability. We can compare then that cost or expenditure that we're going to have to the total amount of sales that we anticipate, and we can determine what our break-even point is. Our break-even point specifically is once we have all of our costs covered, everything beyond that is where we're going to have leftover revenue, otherwise called margin. So a break-even analysis is really important whether you're starting a new project, starting a new business, expanding into a new area, because it helps us understand both what that revenue flow is going to be, or it forces us to go through the process of considering all the things that could happen, all of the risks, all of the bad things that could happen, and somehow we have to come up with an assumption using probability or working through that process to determine both the revenue, and the same thing with the expense side. But break-even analysis then helps us understand, given the cost that we've assumed, how many or how much revenue will it take, how many sales will it take in order to make sure that we at least have our costs covered and we're at a 0 point or we're at that break-even point. So really important, again, in good decision making is knowing what that crossover point is. So starting to kind of lead us to the end of our time together today, but again, we're going to leave time for Q&A and some additional conversation to be had here, batting cleanup at the end of our time together. But to summarize this, financial decision making typically has a framework where we can take a look at what it is we are trying to achieve. So we identify what our financial objectives are that may depend on who the stakeholders are. And once we understand what those financial objectives are, we gather the data that we need in order to be able to analyze that information. Today's webinar was hopefully focusing on some of those finance fundamental concepts that could be used to help analyze your options. They help provide framework, and they also provide analytical results that you can evaluate to determine if that data that you have utilized doesn't meet those objectives. When we have that information, it allows us to make the most informed decisions based on the listing of assumptions that we have put into our process. So again, bringing this full circle is whether you see yourself in all of these areas, identifying objectives or gathering data, analyzing, making decisions from one to all four of these steps. Again, the Finance Fundamentals course is really for you to gather some experience and some foundation to really help you through those steps. It's also important to consider transparency and honesty in our in each of these steps. As we put information together, we want to make sure that we have considered the positives, the negatives, and that we do so in that most ethical way. We also want to make sure that if there are regulations or there are specific compliance requirements, that we are considering those when we are making decisions and when we are gathering information. And we want to also consider corporate social responsibility. So there's formalized ways that we can do that. There's informal ways, even to the culture of our organization or to the culture of a entity that you might be working with. Those things are important to also wrap into the data that you're gathering and how you would go about the analysis of that data. The approach for one organization may be different for another organization based on some of these topic areas here. And so we'll be utilizing things, and you can utilize things in any of decisions that you need to approach, utilizing financial calculators, using budgeting templates, using forecast modeling, calculating ratios, graphing trends, things like that are examples of experiences that we're going to be doing in this 4-week course together. So just a recap here, a few things that we have covered here today. Hopefully, as we've gone through some of these examples, you've thought about real world scenarios where there are decisions to be made, data to be gathered, and you can see how the finance fundamentals can integrate with real life. Action item to engage in course assignments and discussions in the four modules of any of the courses. We do that intentionally through assignments by making it practical to the world that you would be applying this information to, but also providing a weekly time to get together and make sure that discussion and questions are answered as well. And then also providing additional resources to take on both the basic understanding of the various concepts, but also to take this information to the next level. And with that ends my time on specific content today. Turn it back over to the College of Continuing and Professional Studies to finish us up, and then we'll go into a time of Q&A.
Yes, thank you so much, Terry, and thank you again for presenting on this topic and sharing your knowledge on what's to come in the courses that we're offering here in the certificate. So yes, before we enter into our Q&A, we do have just a short two-question poll. This is going to be concerning our webinar productions. It really helps us get feedback for what topics are presented, any ideas that you have, we welcome them. So if you go ahead and take some time to just take a look at those questions. And also the QR code there is a link to a more in-depth survey for our webinar production. So Courtney will also be posting that here in our chat. So if you want to visit that and add a little bit more detail, that'll be great. So I'll give you I'll give you like a minute just to take a look at that poll, and then we'll go right into the Q&A. Also, if you do have any questions, we have a few here, but feel free to submit your questions in the Q&A. Also, if you have any more specific topics that you want to discuss with Terry, feel free to email ccabsinfo@umn.edu, and we can make sure to get those over to her. All right, so we will now move into our Q&A portion here. So our first question is, will there be any more depth to risk assessment beyond the idea that high risk is likely high pay or high loss, i.e., some high risk is not likely to have high payout?
Yeah, the answer to that is yes, we will definitely look at risk more in depth. We will utilize various tools in order to analyze risk. And we will also talk about what the risk tolerance is in various situations. I sort of mentioned that towards the end. It was, a lot of information flying by quickly. But what may be risky to one may not be risky to another. And so having a variety of views, using different tools, using different finance foundational concepts will help you determine whether or not the risk of something fits into the risk profile of your situation.
Great, thank you, Terry. And our next question is, you did go over this a little bit as well, but which budgeting software, if you have any examples, will that be used in any of your courses?
Yeah, so we've made the decision to utilize basic Excel. Typically, we're going to be using templates that will be ready for the students to interact in. Those templates will allow for some flexibility. Again, one of the desires is that we want this to be applicable and useful in your real life, whether that's for personal purposes or business purposes. So there will be some flexibility in order to expand those Excel templates to use them as you best see fit to achieve your goals of being a part of the course.
Awesome, thank you. And our next question is, in the certificate program, will there be any discussion on budgeting or financial planning for government entities?
Oh, great question. So as far as content goes, our budgeting and financial planning discussions will be general, which will allow for any type of entity to be able to interact with the content, with the classroom engagement, and be applicable. There are a number of industries. Government is one noted in the question where there may be specific nuances, and typically generally accepted accounting principles and the accounting codification rules will give us specific guidance in a number of different industries or applications. And while we will not necessarily dig into those fine details in the 4-week course, any entity that attends the information will apply. And as far as working with the instructor, you will also have the opportunity to have one-on-one conversation with them on anything that would relate specifically to the type of entity that you're working with in order to apply the course concepts to your case or to your personal situation that you're utilizing the information with. So the short answer to this is will there be discussion specifically about government entities? Not in the course. However, government entities is one example that certainly applies and would fit in perfectly to the course content.
Awesome, thank you. And I am seeing the question here about interest in the certificate itself. So Terry, this was a focus on the financial fundamentals course. So there is 3 courses that are part of the certificate. I have posted the link for the full certificate. Those classes are listed there for dates. So just click on the class title if you want more information on content as well as the dates offered. But we do offer classes year round. So please use that link there listed in the chat, and we'll also be sending out follow-ups as well, emails on courses to come. So I'm not seeing any other questions here, so I will move on to the next slide, please. Um, One more. Yeah, wonderful. So CCAPS now offers flexible workforce development solutions designed to equip employees with the targeted knowledge and skills your organization needs. Our program include industry-driven bachelor's and master's programs, along with 14 non-credit certificates and over 90 individual courses and climbing. If you or someone in your organization would like to learn more, please schedule a consultation with our business development manager, Beth Lowry. There's also a QR code there listed if you want to explore that a little bit further. And if I can have you go to the last slide, please. As I mentioned earlier, we will send a link to the webinar recording within a week of today's webinar. The recording will also be posted to our CCAPS webinar archive as well as our CCAPS YouTube page. And for our university employee listeners, these webinars are eligible for well-being points. So please use the link if you are interested in receiving credits for that. And with that, our college's contact information is listed on the last slide of this presentation. I just want to thank you all for joining us today, and you have a good rest of your afternoon.